Rich, this week, the Fed, we always seem to like to talk about the Fed, don't we?
Well,
They
everybody
affect
hangs on the
everything.
Fed's word, so I guess we have to because it affects, investor actions, right?
It affects everything. So what was the Fed decision last week that we need to know about?
Well, it was no surprise whatsoever. Yet it seems like everybody was blindsided by it. The Fed decided not to raise rates, or I'm sorry, not to lower rates, to leave them exactly where they were. And everybody heard in December, we're going to cut interest rates 2 to 3 times in 2024. And they all assumed it was going to happen immediately. And the Fed's been saying since then, they've been backing it down. Chairman Powell, all the Fed presidents, governors, whatever, they're all saying, no, higher for longer. We need to see more out of inflation. It's still higher than our expectations and everything else. Um, but the markets have been acting like they've already cut the rates, right? So we initially saw gold go up in December. We saw the stock markets go up. Everybody was happy. The party was back on. And the Fed's like, that's not what we said. The earliest they're talking is the end of this year, not March or May. And now there's still a bunch of people out there expecting May for interest rate cuts. And, it's not what the Fed is saying. If people listened, we wouldn't have all these gyrations and all this volatility in the market. It'd be pretty clear that we're waiting for something else to happen before they start cutting rates, but they expect they're not raising them unless the market tells them otherwise.
When the Fed decides not to lower the rates, how does that affect the job market? Does it?
I don't know that it completely affects the job market, but that's another thing that they're looking at. So they're looking at inflation, right? They want to make sure that inflation is coming down, and it has been coming down, but it got stuck and actually ticked up slightly over the past couple months. So it's still much lower than it was, but the rate of inflation, i.e., inflation is still increasing, is still there. They want it down to about 2%. It's just under 4%. So we're not there on inflation. They're also looking though at the jobs market, right? Because they want to make sure that they're not hurting the economy, throwing us into recession, casting people out of work. Because when the market uh, takes the bad news and businesses see storm clouds on the horizon, they're going to start cutting staff. We're seeing some of that, but the job numbers from last Friday tell us that everything is rosy, right? We created 353,000 non-farm payroll jobs in January, according to the Bureau of Labor Statistics, and that's almost double what the markets were expecting. So they were absolutely, shocked by the jobs report and how it was so good. And that's more fuel to the fire that the Fed does not have to cut rates just yet because the economy is not faltering, sputtering, falling apart in their view. Now, personally, I have major issues with that 353,000 job number. I don't buy into it. I think it's based on a lot of assumptions and, you know, permutations and a lot of fun with numbers. But that's besides the point. The number was very strong, and the market should read that as the Fed's not cutting rates anytime soon.
So now we have the Fed, we have the job reports, we have inflation, deflation, stagflation.
It's
Where does
still
that leave?
inflation.
Yeah, it's
Yeah,
still inflation.
yeah.
So where does that leave investors? What should their expectations be?
So they're hoping the investor psyche right now is still hoping that we're going to see rate cuts, interest rate cuts sooner than later. And what that means is that means the party's on for securities. There's less um, negative repercussions from owning gold or precious other precious metals because right now you can earn 4 to 5%, well in this case 5% potentially, just by putting your money in a bank, right? Although the banks aren't paying those interest rates, that's where their interest rates are. That's the idea, is you can earn 5% just by putting your money in the bank, and inflation is going to take away 3.7%. So you're making money, right, just by holding your money in the bank. So why would you take the risk of owning a stock? Why would you take the risk of owning precious metals longer term? And as long as those interest rates are high, there's competition for assets, for money going into equities and gold. People are going to go to the safe bet, dollars in a bank earning interest. So where does that leave gold? I think that leaves gold for a longer period of time, till the second half of this year earliest, where we're gonna see, the metal prices just kind of hold tight. And that's fine. I just did an interview with Rick Rule, and he surprised me. I asked him what his number one resource investment was going to be for 2024. I was expecting uranium, water, something along those lines, because I knew he's very big on both. And he shocked me. He said it was gold. And over the next 5 years, he's very bullish on gold. And in 2024, he likes gold. 2025, he starts liking even silver more. And part of that is because, right now, maybe 0.5% of investor portfolios are allocated to gold. The mean over many, many years is 2%. So all we have to do is move 1.5% to revert to the mean, and the impact on that small capitalized market of gold is going to be tremendous in terms of price pressure. So I thought that was kind of an interesting take on things. I agree with him. I think gold has been moving upward for some time. And I know everybody wants it to go faster. They want it to go higher, farther, whatever. Gold is doing its job, continues to move up. It's a reaction to the poorly managed dollar, and it's cheaper now and will be cheaper for a little bit longer. I think that spells opportunity for those that are willing to listen, and those that don't will be sorry later. There's no two ways about it. Gold price is going to be higher when they turn to it later on.
Yes, now is the time to get in. So thank you for clearing up confusion
Yeah,
for our readers, Rich, and
I'm sure
sharing
I
your
created
insights.
more too.
The Fed does all the time too, so.
Yes, exactly.
Yeah, no, we really appreciate you coming on and speaking to us every month to help us navigate this world.